Hey, hope you're all doing well out there. This is your September market review. The reason that I put this video together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give you straightforward information about what's going on in the stock market and the economy, and then ultimately how that affects your money. So stocks for the month of September and so far into October here have been pretty volatile. Major stock indexes were down across the board in the month of September, if not flat. For many of you out there, this is the first time in months that you've noticed that your statement was actually slightly down. So not that that's ever exciting to see a down statement, but that's nothing to be worried about because stocks don't go straight up forever. It's okay for there to be a little bit of a pullback, or this isn't even quite of a pullback, but a little bit of a pause every now and then. It's actually healthy that the stock market doesn't just keep going up every single month. So a few charts that I have this month, there's 5 of them that I'm gonna go over that I can talk a little bit more specifically about how I feel the market's doing and where I feel that the market and the economy is gonna be going. The first one is a chart of the 10-year US Treasury note, which the 10-year Treasury note tracks the yield on the 10-year Treasury note, tracks major interest rates. So your mortgage loans, car loans, personal loans are all generally based off of a 10-year Treasury note to a degree. So if the 10-year is going up dramatically, mortgage rates and others generally go in that same direction, same car loans, other things like that. So we saw a big relative spike in the last half of September where you can see it was around 1.3% in that ballpark, and it went all the way up into the 1.5% range by the end of September. It's up a little bit higher than that even now, and as we're sitting here in October. And this was all spurred on by the September Federal Reserve meeting that happened at that very bottom portion there that's highlighted and circled there. That was when the Federal Reserve was talking about what they're going to do with interest rates ongoing and the stimulus that they've been doing to help get the economy or keep the economy going and get on a stronger footing. So they talked about in November starting to decrease the purchasing that they were doing on mortgage-backed securities and treasury bonds, which is why one of the reasons why these, being that they they're buyers of 10-year treasury notes, why these all of a sudden spike the other way. So remember that when interest rates go up, bond prices go down and vice versa. So think of like a seesaw, just classic seesaw at the playground, that when there's a lot more buyers out there, that's going to drive the price of the bond up, but the interest rate is going to go down. In this case, because there's going to potentially be less buyers in November, people started preemptively selling, causing interest rates to go up. So people were selling on this side, it caused interest rates to go up on that side. That's just the way that bonds work. So that was a sign that it's actually a good thing for the economy because we don't want the Federal Reserve forever having to help stimulate the economy. When interest rates go up, it's generally a sign of a healthier economy. Bond market investors generally tend to be smarter investors as well versus stock market investors. That's just because there's a lot less of individual traders in the bond markets versus, generally speaking, it's larger, more sophisticated investors. Next chart I have here moving on is oil futures. So this is the price of oil based on a barrel. So it's been in a huge uptick since the bottom of the 2020 recession caused by COVID. Right now we're sitting above $80 a barrel. One of the major spikes that we've seen here since about probably like mid-August was based on, and you guys have seen this, a big part of portfolios that I have across the board, every single portfolio for the most part has energy as a specific sector within the portfolio. There are some that don't have energy in there, but for the most part, across the board, they have energy as an overweighted sector within the portfolios. I did that at the very end of August, and I still hold that position because I think that oil could potentially keep going higher. And if you're going to be an investor, one of the ways you can benefit by oil prices going up is by owning energy companies. So that's one area I wanted to bring that up, just because a lot of you out there, let's say at least like 90% of your portfolios actually hold what would be referred to as the XLE, or that's the ticker symbol for the ETF. That's an energy ETF that we hold within portfolio. So big reason why is because of that chart there when it bottomed out a couple months ago with oil prices, because of the Delta variant taking off. That caused oil prices to drop off. That's when I purchased a good portion of that for portfolio. So something that I think will keep going higher, which potentially is a headwind for other areas in the market where they're dependent on oil prices being at a more moderate level. So companies that use oil to produce products like plastics and other things like that, that's not a good thing for them that oil prices are higher necessarily. For transportation companies, not a good thing that oil prices are higher. I think airlines, for instance, those are some of the headwinds, as well as obviously individual consumers. If you're driving a car and you need to fill that car up, not super exciting if oil all of a sudden spikes to $100 a barrel and gas prices at the pump go up. But interesting chart I thought would be worthwhile taking a look at and showing you guys. Next chart that I have is getting more into the economic aspects of what's going on in the world that we're living in right now, or as far as the economy goes. So this is a chart showing the payroll change since January 2020, and the big drop off that you see was that there were about 22 million people that were laid off in the COVID drop off, and subsequently there's been a slow tick back up, stair-stepping higher with not a whole lot of pause in there. And just in September there was another close to 200,000 jobs added, which wasn't quite on pace with what they're looking for. We're still about 5 million jobs shy of where we were prior to the pandemic starting, and there's still room for growth there. Obviously, the chart I'll show you next goes into the other side of the dilemma, which is the share of small businesses with positions not able to be filled right now. So this kind of is the polar opposite end of it, and I've shown this chart a number of times, and I keep showing it because the number keeps actually going up. When I first came across this chart a few months ago, the percentage of businesses that had positions to be filled was about 40%. Now we're above 50%. So that number just keeps going higher, despite the fact that there's 5 million less people working right now than there was a little over a year and a half ago before the pandemic started. So that's two sides of that, is that maybe people are retired, maybe people decided they don't want to work, they're a stay-at-home parent now, whatever the case may be. But businesses need employees, judging by this chart here, and 50% of the small businesses are short-staffed. So, that's a good sign for the economy when small businesses are in need, because that means that they're growing as a company, or they just need more people to get the work done that they were getting done before. So that's a good sign that twofold, that those companies are profitable and they're making money, and that those companies are going to then have to pay more to their new employees to be able to hire them, which that's a good thing for more and more people to be getting paid more money people are making. Generally speaking, more money people are spending and or saving. So which both things for us as investors are great things. If they're spending money, that means that the companies that they're spending it on, if they're publicly traded, we likely invest in them, and that means their stock prices are going up. If they're saving money, then also a good thing, because if they're saving it and investing it, if they just put it in their checking account, that does nobody any good except for the bank that they're doing it through. But if they're investing it, again, our stock prices go up, win for us again. So thought that was an interesting chart. And that brings me here to the last one, which was my favorite chart that I came across this month. So saving the best for last here. So I thought that this was an interesting chart just because it showed stocks, bonds, and cash over the last 10 years, 25, 50, and 100 years. So this goes into kind of what I was just cutting on a second ago with cash, where cash right now over the last 10 years at least has made a negative 1% rate of return. So this includes inflation in there as well. So that's why it's a negative 1%. So, taking into account inflation, if you had money just sitting in cash in your checking or savings account, you lost 1% annually over the last 10 years, which compounded, that would be, well over 10% over the last 10 years. So going back over the last 25 years on cash, you've only broke even. Over the last 50 years, slightly over even. Over the last 100 years, same spot, slightly over even. So cash is always the spot where people want to have that available. It's safe. It's now backed by FDIC insurance versus 100 years ago it wasn't. It's a safe spot to hold money. Generally speaking, interest rates keep up with inflation. Right now they don't though. So inflation over the last year has been 4 to 5%, depending on what metric you want to look at. Eventually, the Federal Reserve feels that that's going to come down more to where it'll be a more normalized 3%. So that's still not super exciting to make, to have to make 3% in the bank to just break even. So which we're far away from making 3% in a checking or savings account in any bank for a little while. And you can go back to the first chart looking at where the 10-year bond rate was at. It's only paying 1.5%, and that's locking your money up for 10 years with the US government. So banks aren't going to pay anywhere near that because they base their interest rates on that 10-year treasury as well. So bonds, not much more exciting after interest rate or after inflation, roughly about 3% over the last 10, 25, 50, and 100 years. Stocks over the last 10 years have done extremely well, up 10.5% after inflation, 6-7% over the last 25 years, same spot over 50, and 7.5% over the last 100, which that 100-year period, those are the more time you get in when you're talking about investing, the more that the returns are going to work closer to the averages. So stocks have killed it over the last 10 years. That's obvious here in the chart. If we go back over the last year, stocks have killed it. In any given year or any given month, any given quarter, stocks or any investment can go really in just about any direction. Outside of cash. Cash really isn't going to move much at all. But if inflation spikes up, you're going to lose money to that. But over the longer term, if we're talking about stocks will over time revert to their mean, which is just the average that they've been at, which after inflation is roughly in that 7.5% range. So that's a good spot for money to be growing at, and I feel that after inflation, if we're looking at over the next 10 years, we're going to be somewhere close to that. So we may pull back a little bit from the 10.5% that we've been at, but likely we're going to be closer to that 7.5% range over the next 10 years. Because right now there still isn't any place that you can invest money in a liquid investment, which would be cash, bonds, or stocks, that is going to really yield a whole lot. Because if interest rates do start going up, remember, think that seesaw again. When interest rates are going up, bond prices are going down. So that's not going to be a super exciting place to just leave your money stashed. Cash, as well as you see in these charts here, is not a very super exciting place to have your money stashed either, unless you're planning on using it within the next 12 months. Don't get squirrely with it and decide you want to just throw it in the market and hope for the best over the next 12 months, because that might not always work in your favor unless you're putting some type of hedge strategy on it where you're able to take a little bit of risk to get a little bit of some upside return. So but those were just some charts that I came across this past month that I thought would be interesting to share with all of you out there. Okay, so I just finished up my last round of reviews here in Pennsylvania in September. So if you're the next round of in-person reviews that I'm going to be doing in PA is going to be probably beginning part of December. So for those of you that I didn't see in September, that are on that 6-month rotation where I probably saw you last in June, we'll get together then in December. If you'd like to do a Zoom meeting, I know more and more of you, we've been doing Zoom meetings. I'm always very flexible to do a Zoom meeting. We can go over the exact same things that we would in person, and we can do that via Zoom and catch up that way pretty much any time. I'm very flexible that way. So if you're interested in that and we hadn't talked in September, feel free to reach out to me. I'd be happy to set it up that way. If you have any questions or need my help with something, don't hesitate to call, text, or email. If you have any friends, family members, coworkers, or just somebody you think would be interested in having a conversation with me about their investments, please don't hesitate to give them my contact info. If they prefer me to reach out to them, feel free to give them or give me their contact info, and I'd be more than happy to reach out to them. I appreciate you all taking the time to check me out. Until next time.